Construction finance. Construction work commands heavy capital. Some of the primary expenses include the purchase of raw materials, rent for heavy equipment, wages for laborers, and loads of payment to various service providers and suppliers. Unfortunately, the industry is fraught with the common issue of late payments from creditors, which could slow down the completion of ongoing work or, worse, compel a construction firm to turn down a new project. If you seek to dodge waiting on payments to keep the business growing, construction finance can be beneficial for you. What is construction finance? You can look at construction finance as a type of invoice finance, allowing you to advance cash you will need to pay for the upfront costs throughout a project. The advanced sum should be covered by the payments you are expected to get once your clients start paying you for the job you have completed. You can seek construction finance if you're the contractor or subcontractor. Construction loans are used as working capital or funding for the building of houses, establishments, and facilities, among others, whether partially or from the ground up, as well as rehabilitation and restoration projects. How to apply? You can make an application by submitting to your chosen lender an outstanding billing, which can be staged invoices or claims for payment even if your customers haven't certified them. Besides looking into your proof of an obligation from a client, lenders also zero in on your overall creditworthiness through several factors such as your credit profile. Some require a score of at least 680, need, experience and track record as a contractor, your firm's annual turnover, among others. If you're a small-sized construction company with little experience and a far from perfect credit history, you don't have to feel discouraged from getting a loan as several alternative lenders can still cater to your needs. How costly is it? As construction projects are considered relatively risky, you would find lenders setting high interest on construction loans, at least higher than on a traditional mortgage, which you will pay for under a short-term contract, usually for 2 years. However, if you're bidding for more time to repay your loans, you can also opt for asset-based financing, which offers a longer contract life. Besides the interest rate, other extra fees that go with loans include service charges, discount charges and annual fees. Lenders can give out as much as 70% of the loan application, can reach as much as £50 million for some, but usually require a down payment of at least 20% of the borrowed amount. Meanwhile, some would give you the option to get an advanced sum based on a specific invoice or application for payment or your entire sales record. Lenders usually pay out in installments as the project completes new stages of development. Pros. First, immediate access to cash. Some lenders claim they can transfer funds within 24 hours after an application. Such speed prevents any pause on your operations due to the usual 90 to 120-day wait payment. Second, highly flexible terms. Construction financing is a highly competitive market and, as such, compels lenders to make payment adjustments to capture as many customers as it can. Third, secret service. Construction finance lenders offer a confidentiality agreement to keep your customers and prospective ones from knowing you're building on loan, information that often detracts buyers who opt that a company has its cash flow to prove their financial strength and credibility. Fourth, bad debt protection. With this feature, your lenders can still pay you even if your customers fall into insolvency or cannot repay you, at least any time soon. Cons. First, stringent standards. Despite construction loans being high risk, lenders can still manage to arrange flexible terms you can benefit from, including the quick transfer of funds. In exchange, however, lenders require much more information and documents and would even conduct a site visit. Second, can amount to higher interest rates. This may be the case if you're a newbie in the construction business. However, as with all high-interest financing, repayment terms last for only a short period, which puts pressure on the urgency to retrieve funds from clients before the end of your contract with the lender. Third, defaulting on your payment may bar you from tapping financing facilities in the future. Failing to pay on time will result in a backlog, making it more difficult for you to move forward to commit to your succeeding payments. Moreover, this would taint your credit management profile and narrow down your horizon of lenders willing to offer you their products and services. Provided a competitive and flexible finance package. All in all, would certainly do it this way again.